So today we're going to talk about, last week we talked about time value analysis, and that is a fundamental principle of finance. Today, which is basically talking about return, rates of return. Today we're going to talk about the other fundamental concept of finance, which is risk. So return and risk are sort of the building blocks of finance. And the problem we're going to look at now, which is one of the questions you will be asked next week when you do your case 13, Mid-Atlantic Specialty, is if you were an individual investor, which investments would you buy? That's one of the questions in the case next week. So today we're going to talk about, well, how do we actually answer that question? So, what is financial risk? Financial risk occurs and it's present whenever there is any chance of an outcome being different than what is expected. In almost all financial instruments, almost all financial decisions, there is no such thing as certainty. And as soon as you have uncertainty, that generates financial risk. Now, because we're all human beings, we have certain attitudes towards risk. Generally speaking, it's the possibility of outcomes below or less favorable than expected that really worries us, and that's what makes us concerned about financial risk. Outcomes that are better than expected, rates of return better than expected, that's just gravy. That's great news, but it's not something that makes us lose sleep at night. So generally speaking, when we talk about financial risk, we're talking about some chance of earning a rate of return that's less than expected. So consider two distributions. We've got two investments. A hospital may be considering investing in an MRI or a clinic. We look at all the potential possible rates of return on these two investments. Which investment would you say is riskier? Why? Why is correct? Why?
There's more chance to lose a lot of money in that investment.
Sorry?
There's more chance to lose a lot of money in that investment.
Yes, the distribution of possible returns of Y is much wider than the possible distribution of possible returns of investment X. So generally speaking, this is one good measure of the riskiness of these two particular investments. Y is riskier than X because it has the range of possible outcomes is much wider. So why does this matter? Well, generally speaking in finance, we talk about risk aversion, the attitude towards risk can be classified in three ways. So if I were to offer you a gamble, if I were to offer you two things, one, $1,000 for sure, or you toss a coin and you get either $0 or $2,000. Which option would you choose? Most human beings would choose the sure thing. Why? Because $1,000 certainly is a cash in hand, and they would not be willing to risk the loss of $1,000 for the possibility of potentially earning $2,000, but also walking away with nothing. So the fact that most of you would say the certain $1,000 indicates that most of you are risk averse. You prefer the certain $1,000 to the gamble of $0 or $2,000. Both of those gambles have exactly the same expected value, don't they? $1,000 times 100% uncertainty is the same thing as 50% times 2,000 plus 50% times 0. They have the same expected value, but their risk is different. And human beings, generally speaking, are risk averse. They would prefer the certain thing. If you were indifferent between those two options, what would you be? Risk neutral. And in fact, if you were willing to pay to take the gamble, then you would be risk loving. Can anyone think of someone who's risk loving? A television show, you're fired.
Donald Trump.
Donald Trump, I think, is a classic example of a risk-loving individual. Sorry?
He has money behind it.
So it's more of an entertainment.
Which is my next point. One's attitude towards risk often depends on how much wealth one has. Someone who's very poor perhaps like some of you in this room right now, you're probably unwilling to take a gamble where you could lose $500 or $1,000. 10 years from now, when you're all well earning into the six figures, a loss with $1,000 probably won't be that important to you. So the amount of wealth you have are amongst many things. There are also cultural differences. There are national differences. People in Japan have got very different attitudes towards risk compared to people in the United States, for example. However, for our purposes, we're going to assume that most risk investors are risk averse. So that means, what does that mean? And let's just operationalize it for a second. So we've got two projects here, an MRI and a primary care clinic. And so a healthcare organization is considering investing in one of these two projects. And we'll assume for a second they have the same capital outlay, but they've got different projected rates of return. So why might the rate of return on the MRI be negative 10%? Why could that happen?
You spent money to purchase the MRI, but you didn't have any patient volumes.
Okay, so patient volume is less than predicted. So your revenues are less than predicted. What else? What's the opposite of revenue? Costs could be higher than expected. Perhaps the union signs a collective agreement that's got a higher than predicted salary increase. Why might the expected return on the clinic be 50 plus 50%?
Great administrators.
Great administrators, that's a possibility.
High volume.
Volume is a lot higher than expected. What could cause a great big increase in volume in primary care class? Sorry? Sure, I mean, think the clinic could get really lucky and there could be sickness everywhere, you know? So people are walking in the doors with flu and other things like that. That could project the volume up much higher than expected. Whatever the reasons are, and these are not unreasonable assumptions to make about the potential uncertainty facing any investment, we're going to just look at these as a starting point. Notice the other thing I'd like to point out is that there may be different probabilities of occurrence. You know, our best guess is that it's going to be a 10% rate of return on the MRI and a 15% return on the clinic. However, we're not immune or ignorant of the risk, so we'll weight lower the possibilities of other occurrences. So it's quite common to have different levels of probability. So we simply calculate the expected rate of return in this example of being 10%, which is the sum of the probabilities times all of the expected rates of return. So we're simply going to take the 10% probability times the 10%, negative 10% from the MRI, plus 20% times 0, plus 40% times 10, and so on. And that gets us the 10%. So that is the expected rate of return. This is an investment we have not yet made. So it's expected. We're forecasting into the future. The realized rate of return, on the other hand, is after the fact. It is what did we actually earn on the investment. That's after the fact. So what did we actually earn? So risk exists when the expected rate of return does not equal the realized rate of return. There are very few investments where those two are exactly the same. Can anyone think of one? Can anyone think of a riskless investment, a risk-free investment? Treasury bonds. Okay, so you buy a treasury bond today at 2% interest. You know for certain that 1 year from now you will have 2% more wealth than you had today. Because unless the U.S. government defaults, of course on October 18th that may happen, but unless the U.S. government defaults on its debt, that is a certain investment. Stock market, anything with that are security-based, those are not going to be risk-free. They are going to have risk. So we're going to talk about 3 different measures of risk: standalone risk, corporate risk, and market risk. There are 3 different measures, and they all have different applications. The first and simplest is called standalone risk. And standalone risk assumes you own an asset in isolation, that the organization only has one asset and no other assets at all. So it's a very simplistic situation. And so in this certain circumstance, we can measure the risk by the tightness of the return distribution. I bet all of you thought that you had left statistics behind. You finished Jimmy Bordeaux's course. Wrong. The standard deviation is the measure of dispersion.
So this means that the organization is in isolation, or in terms of the organization is the only one in a particular region that has the asset, or in terms of within the organization, this is the only asset?
No, I would, it's within the organization. The organization has only one asset. So I guess the ultimate example would be a solo physician practitioner with no assets and no debt. Just his or her human capital. So it's a very isolated circumstance, but we're going to talk about that in a minute. So when you have that kind of asset, the standard deviation, the return distribution, can be used to measure risk. And in fact, in the chart we just looked at a few minutes ago, you can actually calculate standard deviation from that table I gave you as being 11% and the standard deviation of the clinic being 8%. So the larger the standard deviation, the greater the risk of the investment. So, to recap, we've got the expected return of the MRI being 10%, and its risk being 11%. We've got the expected return of the clinic being 15%, but its risk being 18%. So, what do you do? And I'll warn you now, this is a trick question. What can you do with that information?
You can make a ratio.
Okay, that's what you can do, but about the information that's there right now.
You need a baseline. Well, you need to think about compared to what you're going to take the decision, right?
Mm-hmm.
So,
But I'm asking you, which would you invest in, MRI or the clinic, based on this information alone? You would take the one for least risk.
And
Sorry?
I said it depends on what you want, but I'd do the one with more risk.
Depends on what you want. And one with least risk. Okay, so the trick question is, the trick answer to the trick question is, you cannot decide. Because, yes, the clinic has a higher rate of return, but it also has higher risk. So how do you trade those two off? There's not enough information in this table to answer that question. Now, I guess I want to emphasize something, because students often interpret risk as being bad. Risk is not bad. Risk is something that you almost will inevitably encounter in all of your personal and professional lives. The issue is, if you want risk, what do you also need?
No, my question is, because you just said a few minutes ago that we're risk averse, so if we're risk averse, like why would we choose the clinic? Like if we want to minimize our risk, like why wouldn't I choose the MRI over the clinic?
Because I said that because if I give you two projects, suppose I give you two MRIs, and both of them have got expected returns of 10%, but one's got a standard deviation of 18%, 11%, and one's got a standard deviation of 22%. Which would you prefer?
The one with the 22.
Right. So all other factors being the same level of return, someone who is risk averse would prefer to have the project with the lower amount of risk. So just because these two examples right now, the clinic has more return, but it also has more risk. So the question we are trying to answer here is the additional risk compensated for by the additional return. So more risk is not necessarily bad if you are compensated for that risk. All of you, when you get your 401ks going a year from now, I know I talk a lot about the future when you're going to have tons of money. I try to encourage you that will indeed be the case. Will you put all of your 401k assets, will you put them all in treasury bonds? Why not? It doesn't have enough return. Almost certainly you will put some of your assets in the stock market, as you should for people who are in your age group. So you will deliberately be saying, I am making a risky decision. I am putting a large part of my 401k into the stock market. Because yes, it's risky, but I expect higher rates of return. So risk is not necessarily bad. It's just you want to be compensated for that risk. So one of the things you can do, as Julian just suggested, is create a coefficient of variation, which is a ratio, where we can essentially take the amount of risk per unit of return. And we do that, you can see, in fact, the clinic has higher rate of return, risk per unit of return. So this is a way of standardizing the two and making a choice between the two. However, as we just talked about, very seldom do we encounter a standalone project.